Okay, so when a guy managing over 6 lakh crore rupees in the Indian stock market has something to say, we all tend to listen. But what's really unusual here is that he's not selling you on the next big thing, he's actually issuing a blunt warning. So let's dive into what this expert is saying about a market that might be a lot riskier than it looks.
You gotta love this story from the legendary Charlie Munger. It really gets to the heart of a big question, doesn't it? Are the people managing your money selling you something that actually works, or are they just selling you something that's bright, shiny, and easy to sell? It perfectly sets the stage for the person we're talking about today.
And that person is Naren. He's the head of ICICI Prudential Mutual Fund. And in an industry that's absolutely packed with those fishing rod salesmen, Naren is that rare voice who's telling you what you need to hear, not just what you want to hear. And right now, he's warning small investors that it's absolutely time to be cautious. Here's why.
All right, first up, let's look at Naren's diagnosis of what's going on. He sees a market that's fundamentally overvalued, and the real danger, well, it's kind of hidden in plain sight. Now this is a really fascinating point. Think about it. It used to be the big banks that finance companies. But today, through a flood of really expensive IPOs and other offerings, it's actually the retail investor. It's your money that's fueling the whole system. You, the small investor, have become the primary risk taker, maybe without even realizing it.
And this is the kind of risk we're talking about. I mean, just look at these numbers. Naren is pointing out that we're seeing stocks trading at price-to-earnings ratios of 50, even 60. Those are, and I'm quoting him here, insane valuations. They're basically a massive gamble on future growth that, frankly, might never show up.
So what does a high PE even mean in simple terms? Naren breaks it down perfectly. A PE of 25 means you're paying a price today that would take that company 25 years to earn back for you. And that's assuming their earnings never grow at all. So you can just imagine what a PE of 50 or 60 implies. It is a huge, huge bet on the future. And if you're thinking, oh, it'll be fine, well, history has a pretty stark warning for us. From 1994 to 2004, the Indian market went through what's now called a lost decade. After the bubble popped in '94, tons of small and mid-cap stocks just poof. It took 10 years, a full decade, for the market to get back to where it started. Naren's whole point is, what's to stop that from happening all over again?
Now, I know what you're thinking. This is the argument you hear everywhere, right? There's so much money pouring in every month from systematic investment plans, from SIPs. Surely that constant flow of cash will just keep propping up the market forever. It's a really comforting idea, but is it true?
Well, Naren is crystal clear on this. He says, look, all that money flow can maybe keep an overvalued market going for a year, maybe two, but it can't defy gravity forever. At the end of the day, the only thing that actually matters is whether companies are making money. And he's warning that for a lot of these high-flying companies, that solid earnings growth just isn't there.
Okay, so the market's risky. That's the diagnosis. So what's the smart move? Well, Naren says the first thing we have to do is learn from the mistakes people made the last time around.
This right here is such a crucial point. We're all told buy and hold, be a long-term investor. But Naren's warning is that that advice is actually dangerous if you're holding a bad company that you bought at a crazy high price. In that case, time isn't healing your wounds, it's making them deeper. You're not investing, you're just destroying your capital.
And here are the exact traps people fell into back in the 90s. As the market got hotter and hotter, people started chasing bigger and bigger risks. They bought lower quality companies. They bought illiquid stocks they couldn't sell easily. And they dug deeper into tiny, unproven companies. These are the exact 3 mistakes Naren is begging us to avoid making today.
So, avoiding those mistakes is one half of the puzzle. Now let's get into the other half. Naren's playbook for how to actually invest in a market like this one. The core of his strategy is diversification, but with a global twist. Just look at this comparison. On one hand, you've got the Indian market, it's expensive, and the potential upside might be pretty limited from here. On the other hand, a lot of global markets are way, way cheaper. Naren believes those markets could give you solid returns for years, simply because they're starting from a much more reasonable place. So here it is, the playbook laid out nice and simple. Step 1, go global. Look for value outside of India. Step 2, think about an asset like gold, not as a huge moneymaker, but as a way to diversify your risk. And step 3, Be tactical. This is not the time to be hunting for the next 10-bagger. Instead, look for solid, short-term opportunities, maybe a 10 to 20% gain, take your profit, and move on.
Now, this doesn't mean you should abandon the Indian market altogether, not at all. Naren still sees pockets of real opportunity, you just have to know where to look.
He's pointing to 3 specific sectors where the numbers still seem to make sense: oil and gas, pharma, and banking. Yep, these aren't the buzzy tech stocks, but they're grounded in some very different and maybe more stable economic realities.
So what's the logic here? Well, it's pretty straightforward. With oil and gas, the valuations are reasonable, so your downside risk is limited. With pharma, that's a long-term story. You know, as populations get older, healthcare only becomes more important. And for banking, the idea is that once all this easy stock market money dries up, good companies will have to go back to the banks for loans, and that's when that sector will really start to shine.
And that brings us right back to where we started, with Charlie Munger and his fishing wisdom. It's not about having the flashiest purple and green lure. It's about being smart enough to go to the part of the lake where the fish are actually biting. And for Naren, that means looking for real value where maybe everyone else isn't looking.
So, the final question this whole explainer leaves us with is a really personal one. After hearing about the valuations, the history, the risks, and the smarter strategies, you've got to ask yourself, are you fishing in a crowded, expensive pond just hoping to get lucky? Or are you actually looking for the waters where the real value might be found?